Well, welcome everyone. This is the July 2024 webinar from Principal Wealth Partners. I am Julina Ogilvie, partner and wealth advisor here, joined as always with Bob Paolucci, our founder and CEO. Bob, welcome.
Hello, happy summer.
Happy summer, and it's a hot one.
Yeah.
So we titled this webinar TikTok. We are finding ourselves now officially in the second half of 2024. I can't believe this. And the point of this title is that we do have a sense of urgency. It is decision time from a couple of different things as we approach year end. And what I mean by that is we have lower inflation, we have a slowing economy. We're going to talk about this. And it is time for the Federal Reserve to make some decisions and pretty soon, in our opinion. And we also have some political decisions that we have to make. And there's a lot of political decisions around the world as well. Is that fair
Yeah.
to say?
It's quite fair to say.
Now, despite
Yep.
all this, the markets have actually moved higher. So the goal for today is to point out where we've come from in the first half of this year, and then to highlight some key areas going into the second half. And I guess, Bob, if you can kick it off by sharing with us the agenda for today.
Sure. Yeah, we streamlined the agenda. We've categorized the topics now. So we'll talk about markets, economy, policy, and everything else. And you can read there on the screen what the subtopics will be, and we'll present them in slide form. So, the title of our presentation, TikTok, it's not the social media platform. That would be way too controversial. But it is the fact that, the past 30 days and probably for the next 150 days or so, there's going to be a lot of critical decisions that need to be made and will be made. And whether we like them or not, they will be made because they have to be made.
Mhm.
And you have things like the Fed has to decide if they're going to keep changing and moving the goalpost to cut rates, how many times they're going to cut, when they're going to start. You have a situation in the Democratic Party where Joe Biden's future is up in the air. Will he be the candidate? Will they hand it to Kamala, or will it be somebody else? Who Trump's VP running mate is? You have major decisions pending with the French elections, the parliamentary elections, and how that's going to shape up soon. The UK just voted and changed the party in power. So there's a lot going on, and there will be more than that going on. And, we think really the next 120, 150 days, in some cases, many of these decisions will be made sooner, are going to be very critical to shaping maybe the next handful of years, policy, lots of other things. So everyone who has to make decisions everywhere is on the clock, hence TikTok.
And
Time is ticking.
yep.
Yeah.
And I think despite all that, let's kick it off and address where the markets are so far for this year.
Yeah, so markets are doing well, right? So you have the overarching S&P 500, the 500 largest companies in the United States, glued together in an index, are up about 17% year to date. The Dow Jones, which is a much smaller 30 stock index of just market leaders, um, doesn't rely as much on one stock like the S&P does, is up about 5% year to date. The Russell 2000 small caps are, up about 1%. We think there's tons of opportunity there going forward. The foreign markets, which are represented by the MSCI indices on the left-hand side, are up about 8 and 9% this year, trailing, again, the domestic markets, both year to date, 1 year and 3 year.
Mhm.
Down bottom, we show that the aggregate bond index, which is the bond proxy, when people talk about the bond market, they're talking about the US aggregate bond index. Year to date is up 0.00, just the way it started the year. We think there's some pretty good opportunity second half of the year and forward there. Corporate bonds are up about 0.5%. Municipals, long-term municipals, are down about 1.5 so far year to date, and high yield bonds are up 2.87%. So that's the lay of the land. We're going to give you maybe a deeper look into the broad-based S&P 500 on the next slide.
Yeah, let's take a look. We've
Because
talked a lot about the concentration of it in the past.
Yeah, because it's not really what you think. The S&P 500, 500, this large index of 500 companies glued together, looks like it's doing quite well, and it is. It's up, 17%. When you minus out just one stock, that would be Nvidia, that takes the index from up 17 to about up 10. So one stock, took about 7 points of performance off the table. And then when you take the Magnificent Seven, which are Apple, Amazon, Google, Meta, which is Facebook, Microsoft, Nvidia, and Tesla, the top seven, you actually have the S&P, let's call it 493, is only up about 4%. So it's having a slightly below average year when you minus out just seven stocks. So is there depth in the market? There is, but the depth in performance of the rest of the market doesn't compare to just the top seven stocks. The top seven are definitely pulling up the rest of the market. It happens from time to time. Is it unusual? It is unusual. We think what we're going to have is more participation from the rest of the market. Really, everyone needs a leader. Every business needs a leader. There always has to be some leadership in some shape or form somewhere. And in the capital markets world, the leaders out of the bear market, keep in mind all these stocks were down significantly in the bear market. They were leaders going down. Now they're leaders going up. Someone has to lead. And right now it's just these seven. I think there will be a lot of catch up played by the rest of the market going forward. It's already slowly starting to happen. So just want to point out, this is really an S&P 500 flying on one engine right now. It doesn't mean it doesn't have other engines that can propel it further. But right now, it's really a party for just the top seven stocks.
So for the first half of this year, basically 2/3 of the return of the S&P came from seven stocks. But to your point, if we're going to continue to be optimistic about the market going forward, we have to look at earnings, which we're always addressing.
Absolutely. So, why does the market move higher? The market moves higher when earnings of the companies in the market move higher.
Mhm.
And what you see here is the trend line of earnings rising, and the green dash line, the purple dash line, the red dash line on the right-hand side are forward estimates. Keep in mind, the forward estimates are never usually accurate. They're usually very conservative and they come in on the low end versus the reality of earnings usually comes in much higher. So we have what looks to be a great runway for future growth in the markets according to earnings projections. And those earnings projections are usually pretty cautious. Keep that in mind.
Yeah.
To prove to you how in sync the direction of earnings in the market are over time, we have this chart. And what you see here is the light blue line is the market and how it moves up over time, and the dark blue or black line is earnings.
Right.
There is a delay in how the market prices earnings, whether it believes it or not. Sometimes it wants to see 2 or 3 quarters of good earnings. So it's not perfectly in sync. It's just quite in sync, let's call it. It's very highly correlated. It's not perfectly correlated. But always remember, if earnings are rising, there's a very good chance that the market is rising and will rise.
Right.
So keep that in mind. Stock prices, generally speaking, of big companies for a long period of time tend to rise for fundamental reasons. Can they rise based on speculation and other stuff? Of course. Yeah. But normally within a few quarters, that speculation gets washed out. It's fundamentals that have to actually be the proof for forward prices.
So the correlation may not be on a day-to-day or week-to-week basis, right? Because of the timing of the earnings and also because we are following the emotions of the news and the media. But over time, there is a very high correlation.
Absolutely.
And so that looking forward, that's another reason for optimism for the markets.
Yeah. We have this conversation all the time, and it's normal to have this conversation. Wow, I wish I bought this stock 10 years ago. Well, okay, but 10 years ago, the earnings were 90% less. So remember, there's really no looking backwards here. It's you move you invest based on the direction of earnings. You have a market that moves based on the direction of earnings. And whether that's up or down, usually in bull markets, they go up for quite some time. And when they go down for a really short period of time. So a bull market, one of the foundational elements is rising earnings, and we certainly have that here.
Okay, great. And let's transition to the economy, and we're going to talk about the economy in the US in a moment, but I think it's also interesting to point out where we fit globally.
Yeah, so the U.S. is the biggest economy in the world, as illustrated by being the biggest dot on the screen.
Mhm.
And we are in the growth stages of our economy. Not only do we have a capital markets and corporate earnings that are growing, we have a total economy that is still growing. It's growing slower day by day, but it is still growing. And this is a great illustration of who's growing, who isn't. Are they facing headwinds, tailwinds, short term, long term? What you see here is, the US and China are in very different places economically. China is, I'm just going to call it in a recession. I called that last year. I'm still saying they're in one.
Mhm.
The European Union is in a recession. The UK is in a recession. We are not. There's resilient growth, as stated on this screen, because we have an import and export based economy. We have services and manufacturing. We have a very diverse economy. Others, like maybe Canada and Australia, they're always going to be a little bit more sensitive to the traits of their specific economy, whereas we have a much bigger, more resilient, more diversified economy. So we're in a good position economically, albeit a slightly worse position than we were last quarter, the quarter prior, the quarter prior, the quarter prior. It's very likely we'll have an even slower economy in the coming quarters, but we still think it will be a growing economy.
Yeah.
Don't worry if it isn't growing. It's going to be because the Fed made a mistake with policy, and they will quickly right the ship. And we'll get to that a little bit more in the coming slides.
Yeah, and I think this is an important visual from an investment perspective because we have talked about why our firm has been a little bit lighter on the international side. We have focused more on the US part of the investments. And again, I think it's just a good visual as to why we've done that.
Yeah.
Let's talk about inflation again.
Yeah, under the economy slides, you have real-time inflation. So this is daily inflation. It was run on the 1st of July, coming in at a whoppingly low 1.85%, lowest we've seen it in a long time. And what we see with this is whenever we look at the daily trueflation, live inflation, the coming month or two or three, we actually see it play out in the coming data. So it is very likely that the next 3 to 4 inflation reports that we get come in cold,
Mhm.
and really prove the point that inflation has fallen from the sky. And it really gives the Fed more than enough of their data to enable them to do what they've promised to do, which is cut rates. So again, measured live, it is sub 2%.
Right.
And measured stale, it's close to 2%. We'll get into that in the next couple of slides.
Yeah, I know we're going to show the Fed's target of 2, but one more inflation number that I think is important to point out.
Yeah, so super core, which is one of the many inflation measurements, made up measurements, which is really taking the CPI data, all of the core services, and you minus out shelter.
Mhm.
So it's all the core services minus shelter.
And
Well,
the shelter has always lagged, right? We've
yeah,
talked.
it has a year and a half lag.
Yep,
So that's why you pull it out to get a better assessment of all the other data. And what
correct.
you see here is we've had our first deflationary print since we were dealing with pandemic issues.
Yeah,
So we just had one. So super core CPI, not only is it low, it just dipped into negative category. How about that?
yeah,
Change
absolutely.
change happens fast.
And one other economic number that we wanted to share is looking at the PMI numbers, which tend to be very a leading indicator of the economic perspective.
Yeah, so Julina, you, myself, and Kyle were staring at some of this data, and this one stuck out. So when you think about the US economy, it's made up of services and manufacturing. In the 80s, we had an enormous manufacturing part of our economy. It has morphed away from that and into more services. And the services side of our economy is much larger than our manufacturing side. So really, this is the growth engine of our economy.
Mhm.
Well, this is the most recent print of the services portion of our economy, and we see that the services index has gone into contraction territory.
Yeah.
Business activity has declined into contraction zone.
Yep.
New orders way down, employment down, supplier deliveries down, inventories down, prices down, backlog down, new export orders down. So we have a lot of contracting, slowing, declining economic data within the strongest part of our economy, biggest part, which is services. Again, when the Fed says they're looking at the data, we just hope that they're looking at all the data
Mhm.
because this data is sending a message that they need to be proactive with their policy.
Right.
Is it volatile data? Are the readings, wild month to month? Yes.
Yes.
But it all starts with one survey of bad data, and then it goes to two, and then it goes to three. So what you're seeing here is just a much slower economy coming in pretty quickly.
Right. We're not talking about a recession. We're
We're
just
not talking
talking
about a
about an
recession.
economy
We're
that's
just,
slowing down.
yeah, we're slowing from, we went from a great economy to an above average economy, and we're quickly sliding into an average to slightly below average economy.
Mhm.
This isn't a recession. It's not as good as it was. And I feel like every month we'll be talking about it's not as good as the last month. So at some point, the Fed has to, you know, change course. And we think that's going to happen really soon based on a lot of this data.
Right. This is the timing of the Fed now.
Yeah.
Yep. And we also, they have talked a lot about jobs. We just saw new numbers. There's a lot of data on this, but let's walk through it.
Um, Never really trust the headlines and always try to understand that the government data is wildly delayed and gets revised, at least in the jobs case, multiple times.
Mhm.
They actually have something called a second revision to the first revision to the initial read. So never get too excited or never, anchor on one good data point or one bad data point. It always gets revised. And here's the proof. Here's about 18 months of data. Yeah, here are the past 18 months of consecutive jobs reports. On the left, slightly to the right of the initial reading, you have a revision which was down, a second revision which in many cases was further down. So you have all these jobs being reported, yet you have an unemployment rate that has been rising rapidly. Why? Well, because they have made revisions to every single month for the past 18 months, and those revisions have been down. So while there were some pretty good jobs numbers reported, headline, they were quietly revised over the next 2 months down to a mediocre level.
Yep.
So we now have an unemployment rate with all these wild new job reports coming out that has risen from 3.4% a year ago to 4.1% today. How about that? And that 4.1% means something. And we'll talk about that in a second.
Yep. I was just going to say the last piece on the economy is talking about commercial real estate, which we've also brought up in the past.
Yeah, real estate, commercial real estate has been quite weak. And, everyone has really been talking about office real estate being weak. We like to point out that it's not just office, it's all commercial real estate is weak or trending towards getting weaker. And here is a great chart from JP Morgan and Wells Fargo that shows this heat map of quarterly since 2021 all of the categories, multifamily, office, retail, industrial, and hotel within commercial, that you see a weakening of all commercial real estate. Is office the worst? Yes, but multifamily is right near it. Everything is trending towards not great. And much of this has to do with the disruption of the pandemic on where we live, how we live, what we do, the space that we occupy. Do we work from home? Do we work from an office? So on and so forth.
Right.
That plus the interest rate environment. Commercial real estate is hypersensitive to a quickly changing interest rate environment. Residential, not so much because the nature of mortgages and the structure of them is so long term, 30 years, it creates other short term trends in residential. Commercial picks up on changing monetary policy almost immediately, and it gets played out usually within 18 months, and you can actually visualize it here on this chart. So there's weakness in commercial real estate. It needs the Fed to come to the rescue, and it needs businesses to get back to work and people to get back to work. That's really what it needs. Will it happen? I think the Fed will show up. I'm not sure that quickly the work trends will go back to exactly the way they were. There will be some modification,
Yeah.
but I do think they will continue to improve. So, does that mean there is an investment opportunity on the horizon? I wouldn't have it in this slide deck if there wasn't an opportunity on the horizon. We just don't think it's right now.
Fair. And if the slide is new to you, because we have pointed out these heat maps in the past, ignore the numbers and just look at the color going from green to red. That is going from strong to weak.
Yeah.
And as you move to the far right in 2024, you can clearly see that there's a lot more red than there was a couple years ago.
Yeah. So something that we're keeping our eye on, and we're just showing it to you.
Yeah. So let's switch to policy. We've addressed the Fed's dashboard in several different ways up to this point, but let's bring it all together.
Yeah. We're taking the Fed's data and rubbing it in their face. So you have the Fed's data goals, and what they do is they say by the end of the year, we think GDP will be at this level, unemployment will be at this level, and inflation will be at this level. And based on that, we've made decisions where we've all voted that if these numbers fall in line, that we'll cut, we'll do this, we'll do that, so on and so forth. What is ironic here is between March and June, the Fed modified some of these levels, thinking that, hey, we'll be able to reach these levels, some good, some bad, by the end of the year, which will justify rate cuts by the end of the year. Okay. How about the fact that the Fed has a 2.1% target for real GDP growth? So GDP growth, net of inflation, to be at 2.1%. They want us to be below that by the end of the year. Well, guess what? We're at 1.4.
We're there.
Yeah. They want the unemployment rate. It's weird to say this. They wanted more unemployment. Yeah, a sign of a slowing economy. They put this 4% target for the end of the year out in March when unemployment was 3.7. Well, guess what? It's July and we have an unemployment rate of 4.1. It exceeds the unemployment rate target for the end of this year. It matches, generally speaking, end of next year and the year after. And guess what? That unemployment rate is going to go higher, not lower. So inflation, two calculations, both PCE, not CPI. The PCE inflation target is 2.6 by the end of the year. Well, guess what? We're there. Core PCE inflation is 2.8. Well, guess what? We're lower.
Right.
So here's the data
Right.
that the Fed uses to make their decisions. Well, guess what? It's time to make a decision. Tick-tock, you're on the clock.
TikTok on the clock. And then just maybe to take it one step further, we can also look at the individual voting members, what's called the dot plot, to see what their forecast is.
Yeah, so these dots represent a voting member of the Fed. There are a lot of very vocal non-voting members of the Fed who you really shouldn't listen to. These are the actual votes for current and future monetary policy by the voting members of the Fed. And what you see here is by the end of this year, the Fed, with their dots, have us coming down by about 2 cuts, some coming down, actually many wanting 3 cuts. By the end of next year, an additional 1, 2, 3, 4 cuts. By the end of the following year, an additional 1, 2, 3, 4 cuts. And long run, so into 2027, an additional 2 cuts.
Couple of cuts, yeah.
Yeah. So this is the predetermined, if everything happens slowly the way we want it to, and it never happens that way, the Fed will get rates down by 50%, 60% over the next 3 years. We think that will definitely be the case. It will just happen much sooner, like it always does.
Yes.
So you have the Fed saying, we'll cut rates from 5.5 to 5.1 by the end of this year, down to 4.1 by the end of next, by 3.1 the year after that, and down to 2.8, 2.75 after that. So, yes, we agree with the Fed, and they should start doing that now.
I always think of Fed policy, I think of a pendulum, right? It just always seems to go a little bit too far in both directions. And so I think that's what you're alluding to right now.
Yeah, or the sound that the Three Stooges make when they come on television. I think it's the whoop, 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 whoop. So they do all this work and they put it all together and they do
Yep.
this dot plot, and then the proverbial stuff hits the fan, and then they throw everything away and they have to accommodate what is happening.
Right.
And I think very soon they're going to have to accommodate what is happening, and they're going to have to do something about the slowing economy, the rising level of unemployment soon. Otherwise, they'll be fighting a fight they don't want to fight.
Well, thank you for that. Let's switch to fiscal policy.
So, yeah, this is under the policy heading.
Mhm.
So that we just showed you monetary policy. Now we have fiscal policy, and we just illustrate it through the lens of interest expense. So you see in the past 3 or 4 years, our interest expense on all of our debt at the government level went from about $500 billion a year to over $1 trillion. That's a lot of debt and that's a lot of interest. And that is not a sustainable path. Hopefully, TikTok, we're on the clock here. There are decisions made by the people we elect at all levels of government to do something about this,
Mhm.
because having the interest on our government debt become the single largest outlay payment in the United States is not a good thing. There's a lot of waste, and
And
uh,
it doubled in 4 years.
doubled in 4 years, which is really just
Mhm.
it's an unsustainable path.
Yeah.
So decisions will be made, hopefully soon, as to how to deal with this. I can tell you one of them is through the lens of monetary policy. There's a reason why we won't be able to have high rates for a long period of time. It's because it will strangle the US economy.
Yeah.
And it'll strangle it because we have a massive amount of debt with no ability to actually pay cash for the interest expense. We just have to borrow more money. And if you were a business, you would be bankrupt. And if you were an individual, you would be getting no credit from anybody.
Yeah.
But because you're the US government, it is allowed. So,
And if you do the math, it's a whopping 2.74 billion a day in interest payments
per day,
per day.
per
Yeah.
day. Yeah,
So
that's a lot of spending around the clock.
something needs to be addressed there, of
Julina,
course.
I think, did you say it's the same as what your kids spend?
Yeah, yes,
Is
that's
that
what I
what's,
feel like.
okay, gotcha. Yeah, well, kids are
Sometimes I
expensive.
feel like that when I leave Costco too. Oh
Right. Yeah.
yeah. So we're going to switch to this conversation of this on the agenda of everything else.
Mhm.
And we wanted to kind of take a look at adjusted gross income by state and to see a trend occurring here.
Yeah, there are actions and there are reactions. There are consequences. There are things that happen, and there are things that come from things that happen. And what you have here, interesting chart from the IRS. It's a little stale, but it looks worse, I guarantee it. Showing from 19 to 2022, states that lost adjusted gross income and states that gained adjusted gross income. And what you see here is pretty massive. California, New York, Illinois, New Jersey, they lost quite a bit of adjusted gross income tax receipts. And Florida, Texas, South Carolina, and Tennessee gained a
Mhm.
ton. I mean, what you deduce from this is it's hard for California to raise a lot of money at a low interest rate and pay their bills. Same for New York, Illinois, New Jersey. There are a lot of initiatives, a lot of things to spend money on, a lot of infrastructure that has to be dealt with. And when you're trying to deal with it with a heck of a lot less income at the state level, something's got to give. We invest in municipal securities for our clients, and this is something that we're well aware of. Maybe we don't show this illustrated, talk about it enough, but now we decided to give you a little snippet of some of the stuff that we look at.
Yeah, no, that's great. Another data point that we found, and we talked a little bit earlier about the state of the world, but this one is really addressing pensions that are just in Europe alone.
Yeah, pensions, entitlements. So in Europe, there's just a massive amount of government pensions, right? And what you see here is a combination of early retirement age, providing these pensions for a lesser amount of years of service, and a pretty substantial pension for not a substantial contribution financially to anything. So, a good illustration of the level of underfunded and unfunded entitlements as a percentage of the country's GDP. Oh my God, we may want to visit Europe and maybe adopt some of their policies, but certainly none of the financial policies, because the level of underfundedness and unfundedness in Europe is, it just makes your eyes pop out.
Right.
As an example, Spain is unfunded, underfunded up to 500% of their economic annual output. That's a whole you can't.
That's a percent, yeah.
That's ridiculous.
And Bob, just to clarify, when you talk about unfunded, right, there's no direct pool that they can rely on, which means that they need to rely on tax revenue going forward to take
Any
care
and
of.
all of it,
Yeah, yeah,
however they get it.
yeah,
That taxes, income taxes, sales tax, anything that they can get, they got to throw into a bucket and pay the various things. While the burn rate of the money that comes in versus going out,
yeah,
it financially looks like any dollar that comes in quickly goes out, on top of the massive amount of borrowing that they've done for a very long period of time in
right.
Europe. It is wild. This is a wild chart. And it also kind of illustrates to you how it cripples economies,
Yes.
right? You have sort of a very below average wage, at
Mhm.
least relative to the US, where you can't, as a consumer, do much. You know, there are many people that have these government pensions. They don't make a lot more. They can't consume a lot more. They're very, very hypersensitive to inflation and the change in price and the change in currency.
Yeah.
It's why these things are so important overseas and maybe less so to us. This is amazing. And it also tells you why we are light when it comes to investing overseas.
Yeah.
You know, because at some point, this level of underfunded, unfundedness just goes away.
Right.
Where, sorry, we just can't pay you, or we have to pay you less. And that's not a very good strategy for the consumer overseas.
Yeah, and there's another underlying issue that you and I were talking about earlier with these pensions, both domestic and abroad, and that these pensions have had over the last number of decades high return assumptions that have not changed moving forward. So they are still predicting a higher rate of return that if they don't see, they're going to have to find another way to make up that difference.
That's a very good point. Yeah, they're still saying, "Hey, we'll make 15% and crawl out of this hole," and they never do, and they never have.
But if
They
they admit to it, it looks worse.
if they admit to it, it looks worse because then you have to have major reform.
Yep.
So they'll just say, "Well, the long-term estimates for market growth and
Yeah.
bond market yields and cash yields are going to be much higher. We have 100-year horizon, and we'll use the 100-year data looking backwards." So that's not the case, hasn't been the case, and very likely won't be the case,
Right.
which means the gap will never be plugged, which means there'll be some other issues out there in Europe. So just thought we would point that out to clients.
No, it's a great point. Thank you. And I think one last element on the agenda here is we're finally here to talk about the election.
It's election time, and you can't
I was
run.
trying to hold off, sorry.
Yeah, it's on your phone, it's on TV, it is everywhere. Whatever is going to happen is going to happen. And we like to dig down into the why. And here's an Ipsos poll and a Gallup poll, two very popular neutral polling entities. And you have two things here. So you have number one, America's satisfaction with the way things are going in the US, the age old, how are things going? And the way they're going is either going to create change or not. And right now we're at a level of satisfied of only 21%, which is near the pandemic and financial crisis low.
Yeah.
You know, the average over the past 30 years is about 40%. We're currently at 21, very low, uniquely low. Number one. Number two, you always want your candidate to be addressing your issues or the things that are important to you. And here's a list of them from Gallup as of a month ago. Number one is the economy. Number two is inflation. Number three is crime and safety. Number four is healthcare. Number five is protecting democracy. Number six is immigration. Number seven is gun violence. Number eight is America's standing in the world. Where did that one come from? After that, I'm actually shocked this one is so low. Access to abortion has fallen quite a bit. And then just below that is the war between Israel and Hamas. So certainly lots of issues. The economy is slowing. Inflation is still rising, just at a much slower pace. Crime and safety has grown exponentially. Healthcare, question mark. Protecting American democracy. I think both sides believe democracy is at risk. The immigration situation is a mess. Why are the polls showing what they're polling? Well, it's because of the issues that are important to people and the direction of the issues and what's being done to address the issues, as can be seen in the American satisfaction with the way things are going. You tie them all together and it paints a certain picture. It's undeniable.
It is. And I do think it's important, despite our sensitivity to all this, the markets do tend to see through at times, and over the long term, they still perform the way they do.
Yeah, historically, the markets do exceptionally well whenever there's a new president in place when compared to a reelected president, right? So you have, this goes way back, but years where there are a new president coming into office, those years are averaging out at about 12.6% versus a reelected president year where it's 7.4 versus all years, which is the S&P 500 over a 80-year period of time at 10.7. So when a new president gets in, there's usually half the country very excited about various things, policies, so on and so forth. And that euphoria, whether it be for most of the country, a portion of the country, so on and so forth, provides real activity and a real push in the capital markets. So I thought we would show that to you. But with all the nonsense that we've been talking about when it comes to politics, of which most is nonsense, keep in mind there's so much more nonsense out there. We'll call it noise.
Yes.
There's lots of noise out there. There's only a small amount of information. And then within that small amount of information, there's only a minuscule amount of stuff that might actually be useful. Keep that in mind when you're bombarded with commercials, newspapers, articles, links from your friends, spam emails from your friends. When the news stations are trying to pump the news of the day, breaking news, a lot of it's just noise. Rarely is it information, and very rarely is it stuff that's actually useful. Keep that in mind. Take a deep breath. Get through the next couple of months. It's going to be tough for both sides politically and everyone in between, but we'll get through it like we always do, and we'll continue to do the good things that we've been doing for you, our clients.
That's great, Bob. Thank you. I love that we end with these types of slides. It's great to go through the perspective of the markets and the economy, but at the end of the day, this is one of the reasons that we run financial plans for all of our clients, and we make sure that they're still on track. And the investments are certainly important, but at the end of the day, we need to stay focused on what we can control. So
100% correct. And don't drive yourself crazy. I read some article recently that said one thing that has been negatively contributing to the mental health of people in this country that has risen from made no difference to now makes a big difference is the consumption of news,
yes,
which is quickly becoming the consumption of garbage and irrelevant information and inaccurate information.
yeah.
So I hate to tell people to be less informed, but I feel pretty confident if I tell you to stop watching the news that you'll have the same level of information because most of it isn't that useful. So give yourself a break from the news, go out and walk, take a jog, a swim, go play some golf, go in the garden, and get away from the news, the noise, politics, the back and forth, and go enjoy your life.
When 15-year-olds are showing election information to their parents off of TikTok, as my daughter was this weekend, it's interesting to see where we are with watching everything that's going on around us. So keep that in mind.
Agreed.
Yeah. Thanks, Bob, for all the information as always. And we thank everyone for their trust, for the time and attention today. And if you have any questions, please feel free to reach out to any of us here at Principal Wealth Partners.
Great. We'll see you in August.
Sounds good?